Financial statements. A deep dive into understanding the balance sheet, income statement, and cash flow. Financial statements are the cornerstone for assessing the financial health and performance of companies. They offer detailed insights that are crucial for a wide range of stakeholders, including investors, creditors, company management, and regulators. A solid understanding of the balance sheet, income statement, and cash flow statement provides a more comprehensive picture of a company's financial status, its ability to generate profit, and its capacity to manage cash flows effectively. These financial reports help answer fundamental questions such as, is the company profitable? Is it growing? Can it meet its financial obligations? Is it managing its resources efficiently? 1. Balance sheet, statement of financial position. The balance sheet is a snapshot of a company's financial situation at a specific moment in time. It reflects what the company owns, assets, owes, liabilities, and the amount of equity invested by shareholders. This provides key insights into a company's financial structure, liquidity, and its ability to meet obligations. Key components of the balance sheet. Assets. Assets represent everything the company owns or controls that is expected to bring future economic benefits. Assets are generally classified into current and non-current. Current assets. These include items expected to be converted to cash or consumed within 1 year, such as cash, accounts receivable, money owed to the company by customers, and inventory, goods available for sale. A healthy level of current assets is crucial for maintaining liquidity, ensuring the company can meet short-term obligations. Non-current assets. These are long-term investments that the company expects to use for more than 1 year, such as property, plant and equipment, PP&E, patents, goodwill, and long-term investments. These assets are typically tied to a company's growth and operational capabilities. For example, a manufacturer may invest heavily in machinery, a non-current asset, to produce goods efficiently. Liabilities. Liabilities represent what the company owes to others, its financial obligations. Like assets, liabilities are divided into current and non-current. Current liabilities. These are obligations that the company must pay within the next 12 months, including accounts payable, money the company owes to suppliers, short-term loans, and tax liabilities. The ratio of current assets to current liabilities is an important liquidity metric, known as the current ratio. Non-current liabilities. These include long-term debts, such as long-term loans, bonds payable, and deferred tax liabilities. Non-current liabilities are indicative of the company's long-term financing structure and its leverage strategy. A company with high non-current liabilities may have significant debt obligations, but may also have the capacity to generate long-term growth through investments financed by this debt. Shareholders' equity, owner's equity. Equity represents the net worth of the company and is the difference between total assets and total liabilities. Essentially, it is the amount that would be returned to shareholders if the company's assets were liquidated and its debts paid off. The primary components of shareholders' equity include share capital. This is the money invested by shareholders when they purchase the company's stock. Retained earnings. This is the portion of net income that the company keeps after distributing dividends to shareholders. Retained earnings are reinvested into the business to fuel growth, fund capital expenditures, or repay debts. Additional paid-in capital and treasury stock are also sometimes included, representing excess amounts paid over the par value of shares and the value of stock repurchased by the company, respectively. The balance sheet formula. The balance sheet is governed by the fundamental accounting equation: assets equals liabilities plus shareholders' equity. This equation must always balance, illustrating that a company's resources, assets, are funded either by borrowing, liabilities, or by investments from shareholders, equity. Investors closely scrutinize this equation to understand how much of a company's financing is coming from debt versus equity, giving them insights into financial stability and risk exposure. 2. Income statement, profit and loss statement. The income statement is a detailed report that reveals how much revenue a company generated, how much it spent, and the resulting profit or loss during a specific period, typically a quarter or year. It is instrumental in determining the company's profitability, cost efficiency, and growth trends. Key components of the income statement. Revenue, also called sales or turnover. Revenue represents the total amount of money generated from the sale of goods or services. This is the starting point for measuring a company's ability to generate value. Revenue can be further broken down into operating revenue from the company's core activities and non-operating revenue from secondary activities like investments. Cost of goods sold. COGS represents the direct costs associated with producing goods or providing services, including raw materials, labor, and overhead. Subtracting COGS from revenue yields gross profit, which is a critical indicator of how efficiently a company manages its production or service costs. Gross profit equals revenue, key COGS. Operating expenses. These are the costs involved in running the day-to-day operations of the business, excluding key COGS. They include selling, general, and administrative expenses, SG&A, such as wages, rent, marketing expenses, and utilities. Companies strive to control operating expenses to maximize profitability. Operating income, EBIT. Operating income, or earnings before interest and taxes, EBIT, reflects the company's core profitability, showing how much profit it generated from its primary business operations before deducting interest expenses and taxes. Operating income is a key measure of a company's operational efficiency. Net income, net profit. Net income is the bottom line, the ultimate measure of profitability. It is the total profit after all expenses, taxes, and interest are deducted from revenue. Net income equals revenue, COGS, operating expenses, taxes, interest. Net income is a crucial metric for investors as it represents the profit available to shareholders. Increasing net income signals a company's improving financial performance and ability to reward its investors through dividends or reinvestment. 3. Cash flow statement. The cash flow statement tracks the movement of cash in and out of the company over a period. It is divided into 3 main categories: operating activities, investing activities, and financing activities. Unlike the income statement, which is based on accrual accounting principles, the cash flow statement focuses purely on cash transactions, making it essential for assessing liquidity and financial flexibility. Key sections of the cash flow statement. Cash flow from operating activities. This section reports the cash generated or used by a company's core business operations. It includes cash receipts from customers and cash payments for expenses, salaries, and taxes. Positive cash flow from operations indicates that the company can generate sufficient cash to maintain and grow its operations. Cash flow from investing activities. This section captures cash flows related to the purchase and sale of long-term assets, such as property, equipment, or investments in other companies. Cash used in investing activities typically reflects capital expenditures, CapEx, which are investments in assets that will support future growth. Negative cash flow from investing activities is not necessarily a bad sign. It often signals that a company is investing in its future. Cash flow from financing activities. Financing activities involve transactions with the company's investors and creditors. This section includes cash inflows from issuing shares or borrowing money and cash outflows from repaying debt, repurchasing shares, or paying dividends. This section helps analysts understand how the company is funding its operations, whether through equity financing, debt, or returning value to shareholders. Importance of cash flow. A company can be profitable on its income statement, but still struggle to generate enough cash to cover its obligations. Therefore, the cash flow statement provides critical insight into the company's liquidity, solvency, and ability to invest in future growth. Positive cash flow from operating activities is often seen as the most important indicator of financial health, because it shows that a company can sustain its business without relying on external financing. The importance of financial statements. For investors, these statements provide the data needed to assess a company's profitability, growth potential, and financial health. Investors can evaluate trends in earnings, debt levels, and cash generation to decide whether to buy, hold, or sell a company's stock. For creditors, lenders use financial statements to gauge whether a company can meet its debt obligations. A strong balance sheet and positive cash flow are crucial indicators of a company's creditworthiness. For management, internal managers rely on financial statements to make informed decisions about budgeting, investment, and strategy. Monitoring financial performance helps them improve operational efficiency and maximize profits. These three key financial statements, balance sheet, income statement, and cash flow statement, work together to provide a complete picture of a company's financial status. By analyzing them thoroughly, investors and stakeholders can make more informed decisions about the future of the company.